Has the stock market reached the top? Riz and I are going to talk about it. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our Elite webinar. Now, if you are watching the replay or are watching us on YouTube and you've not done so, do me a solid, smash that like and subscribe button, click the bell icon right next to it to get notified every time we upload a new video here, because you are not going to want to miss anything with what's going on in the market. And I've got the man himself. Riz is back. How you doing, Riz?
Doing good, Chris. It's good to be back.
Oh, we are glad to have you because, man, there have been a lot of happenings in the market since the last time we had you on. So we have had some absolutely crazy price action the last couple of days. Now, I know we didn't, touch on it too much, but I'm gonna just say I told you so with the rate announcement, or rather the inflation announcement. Inflation came in hot again, third time in a row. And we saw that price action on Tuesday go absolutely nuts. And then Friday, what an absolute selling candle we've had here. Riz, my goodness, it has been a pretty wild ride here the last couple weeks since we've last had you on. Man, what are your thoughts on what's going on in the stock market these last couple weeks?
Yeah, yeah. Obviously, I haven't been on the webinar for the past few weeks, but of course, that doesn't mean I haven't been watching. It's been a difficult trading past few weeks. What we have seen, you're absolutely right. The last week has been quite the doozy in terms of price action. You can see the major red candles there, and then kind of like an engulfing pattern. It looked extremely bearish on Thursday the 4th, a couple of weeks back, but not this week, but the week before. And then all of a sudden, the market would come back, and a lot of indecision, right? With these candles that you're seeing, ultimately a lot of uncertainty in the market, especially if you want to look at it from a technical standpoint. You could say, the 5250 area is like that hard resistance point. We've had the market touch that point, 5250 area, like probably two, three times already. You can see with the candles, and then reject. Um, and then once it breaks below the 5200 level, you can see that it kind of just gives way, right? So Chris has nicely marked that with the yellow line there. That's perfect. That's kind of like our all-time high area. Again, nothing specific. I'm not too concerned with whether it's 52, 51.50. Like, I'm not too concerned with that. Generally speaking, round numbers, full large numbers are usually the key areas where you want to keep an eye on. And that's kind of what we get with 5250. The break below 5200 is also another area, but that's kind of like that consolidation kind of zone. 5200 is important as well. And a break below that, you can see, kind of brings us back down to the 5100, 5125 area, which is what I think, Chris, that the yellow line is the 50-day
Yeah,
moving
that's
average.
the 50-day moving average there. And I mean, it just hit that just perfect.
That
And
is just
just
right on the money there with the 50-day moving average. And then Chris also has that green or teal
trend
trend
line.
line, which again has been respected so far pretty nicely, as you can see back in even the start of 2024, January, and then obviously it's just been taken off away from it. But now we're getting closer to it, right?
Yep.
We'll see if that trend line holds. Me personally, for me, it's more so that 5100 area now. It's going to be key. If we break below 5100, I would not be surprised if we see the market go back down at some point. Maybe not direct plummet, but back down to 5000 level. And that's another area we want to be mindful of. All right. So the SPX, keep in mind, remember, it's not too much about the exact specific decimal points, exact key numbers. Keep an eye on these key zones that I've outlined. Maybe mark them on your own chart, make note of them, and see where that goes, because so far so far right now, it's definitely not looking too bullish, especially with the last couple of weeks. You can see it's kind of curled over. When the market curls over like this, our job is to figure out, is this a point where it's going to settle, and then this little mini dip, not even substantial at all, considering how far the market's run since end of October. I feel like, look, this may be something that we need to continue to monitor. I personally am predominantly cash still. Obviously, you've gone in and out the past few weeks on certain positions, and they've done well. But I continue to kind of, I would say, pivot or slant bearish for this market environment, especially with the whole rate stuff, and we'll talk about that later.
Yeah, definitely. We definitely need to talk on that because I've been harping on that for the last couple of weeks. I definitely want to get your opinion on it. But let's take a look here at the breakdown for the S&P 500 and kind of see what's going on with the different sectors right now. And I need to click the year-to-date button. Apologies for that. So we have seen this meteoric rise in energy with over the last couple of weeks. So really just going kind of nuts. Of course, that's very closely tied to oil, but tech and communications still doing very well. But man, financials taking a beating this week. And most other the indices are coming down as well with the market as it starts to, sell off, and we're getting a lot of this, it's not really confidence inspiring price action, I guess would be the best way to put it. So yeah, energy really just ramped up hard, a couple weeks before, now big sell off here. And yeah, looks like we've got some others. Obviously, real estate still in the toilet below the zero line, but everything else doing pretty well. We're seeing, consumer staples, healthcare, utilities, consumer discretionary, all hovering right around that zero line, basically flat on the year so far. And obviously, our overperformers are still going to be tech, communications, and energy. Riz, what are you seeing here with this breakdown for the S&P 500?
Yeah, the sectors here, again, not all of them, but the major ones. What you said with energy, like last I was on, energy was underperforming the market, right? To give you an idea how big of a turnaround things can be in just a few weeks. Right now, the energy is like the top performing sector in the S&P 500. Big, big, big change, right? Obviously, all of them kind of just all sectors pretty much kind of curling lower alongside the broader market. But what we see here is not surprising. Once the market dips lower, and a little bit of color when it comes to the real estate sector is that we've seen a little bit of a pullback, a further pullback than anticipated in real estate sector, whether it's, um, all real estate based companies, whether it's REITs, whether it's holdcos, mortgage REITs, all these kinds of things. We've seen them pull back a little bit simply because as the rate environment or the rate projections for current interest rates and future rates has shifted, which Chris and I will talk about in a bit, that's kind of weighed heavily on the real estate sector because once you have a higher rate environment, what that means is people are able to get a higher risk-free rate of return, right? You can hold treasury bonds, you can use bonds as a whole. You can use even savings accounts or more high interest savings accounts. People have a lot more options for a risk-free rate of return that are decent, right? Like before, let's say 2019, 2018, you had cash in like a CD or you had cash in like government bonds. You'd get like maybe 1% and 1.5%. And after inflation, it was negative, right? So you were still eroding money. Now it's shifted the last 2, 3 years in a higher rate environment. Yeah, I would say even in a more normal rate environment, people have more options for a risk-free rate of return, and as a result, that weighs on other income-based sectors like real estate, even utilities. But utility is still holding up fine, kind of well for now. But real estate, because it's a lot more riskier, there's a lot more risk now in real estate. Not now, but the past, let's say, 3, 4 years, ever since COVID, really, there's been a massive destruction in commercial real estate. A lot of liquidations, bankruptcies, and this sort. Even recently, I mentioned on social media about I think there's that one tower. I think it was an AT&T kind of building, office building that sold for like 3.5 mil. A massive, massive uh, office building. So uh,
Crazy.
it's crazy how things are moving.
Yeah, no, I mean, the occupancy or lack of occupancy, actually, the vacancy rate on some of these office buildings right now is staggering, and that's definitely got to be weighing pretty heavily on the real estate market. But let's take a look here at the asset classes. And I alluded to this earlier. Oil has definitely been on a very nice move upward here since looks like about December of last year. Of course, I've got my fortune telling trend line that is never wrong anytime, 100% always right here. You heard it first. We've definitely been kind of coming back up over that 85.50 area. And let's see, where did we close on Friday? 85.66 a barrel for light crude. So Oil definitely coming up. I'm feeling it at the pump. I'm pretty sure everybody else is feeling it at the pump. But I don't know if you're looking to buy jewelry anytime soon, but man, gold has been on an absolute parabolic move. And, from my understanding, I heard there's a lot of central banks are buying gold right now, really kind of getting into that. Riz, what is your take on this parabolic move in gold? This seems rather unprecedented to me.
Oh, yeah, gold, man. That's been an absolute wild move. I did not expect this. I don't think anyone expected it. That's why a lot of people are talking about it. A lot of people are quite shocked as to this move in gold. Like that's huge. That's a massive move, Chris. Like I don't think people fully recognize unless like you're really familiar with gold and other commodities. This is a massive move. Like I'm kind of shocked, right? Like I've known, obviously, like I said, I haven't been on the webinar, but I'm aware, of pricing on these, and just to kind of draw home the point with this chart, like wow, like when you have something like gold moving this much, there's kind of like this inverse dichotomy going where like you have the market's pulling back a little bit, but not much. It's still up there. You have commodities like oil going up. You have commodities like gold going up, but gold is outperforming all of them. Obviously, you have silver as well because silver moves alongside gold, but you have those two metals just leading the charge, and it's quite significant. Like this kind of move in this short of period of time, especially after how gold has moved in the past year and a half, 2 years, is wow. It's kind of mind-numbing, and this is a signal. This is a signal that something is going on. There are investors, funds, retail institutions, you name it. People are now looking to gold as a potential asset class to hold, to have exposure to in case things get worse. Remember, over the past 2, 3 years, if you've been on and paying attention, you would see me and Chris say, well, gold isn't acting as much of a hedge. It's underperformed. Well, guess what? That whole narrative's changed now. It took a few years, but it's changed. Gold is now doing amazing. It's actually in the past 3, 4, 5 years, I think maybe in the last 5 or 10 year period, has actually outperformed the S&P 500, which is something I never thought I'd say 2 months ago, right? So it goes to show you how much of a move this is. Gold does not move this way. Commodities don't move like penny stocks. Commodities don't move up and down 10, 15, 20% in a month, right? This is so absurd. And this is very crucial that I talk about and you make note of this, that the market is holding up. The bond market is giving a certain signal. The interest rate futures market is giving us another signal. The gold market is giving a completely other signal. The US dollar market is giving another signal. So we have all these pieces of the puzzle together in front of us, but they might all be a piece from a different puzzle altogether, if that makes sense, right? It might be a different picture altogether. So it's so hard in this environment, in this landscape, to make sense of it all. But of course, that's my job, and for those in elite will know exactly kind of what I'm doing, where I'm leading, why I feel a certain way, and then obviously it's their job to do the best to follow along. But for those of you on the webinar live and watching the replay who either are not in elite or are, the gold has just been an absolute rock star the past few weeks. And again, no one anticipated this. It's all at once. This is telling you that institutionals are involved. There's commodity trading institutions that solely focus on trading commodities. There's obviously world sovereign wealth funds. One of the largest net buyers of gold has been China.
Hmm?
Okay, we usually know India is a large consumer of gold, but mostly from a retail, like they usually buy gold, a lot of gold, for cultural reasons and all that. But from a wealth country sovereign standpoint, uh, as protection, China has been buying a lot of gold. They've been dumping U.S. treasuries and buying a lot of gold.
Definitely a data point to keep an eye on because, yeah, like I said, I have never seen gold move like this, this fast and this much. I mean, it's like, I think I measured it was like 17.5% since here the middle of February. That's just insane.
Yeah.
All right, let's take a look at the bond market. You were alluding to it earlier and the US dollar. So, bond yields have definitely been creeping up. But yeah, here in the last couple of days, definitely a very large, pronounced move in the bond yields here. We are still seeing that, inversion where the 2 year, bonds are outperforming the 30, at this point, and the 10 for that matter. But yeah, Riz, what's going on with the bond market here? Because, I think we're kind of starting to see the bond market saying, okay, maybe these rate cuts, excuse me, are not coming.
Yeah, I'm glad you mentioned that. So finally, I've been waiting to get into the whole rate conversation, and here we are. Um, Chris and I, again, Chris, we can take a victory lap here.
Oh,
We've been
I'm
saying,
ready to. I'm
yeah,
ready.
I know you were ready. You were born ready. For us, we've been saying over the past what, even I would say Q3, Q4, that although the market was talking about multiple rate cuts and starting in Q1 of 2024, we were of the notion that look, we don't think that's going to happen. We might probably see rate cuts, but I don't think we're going to see them in Q1, maybe not even Q2. And we've been continuing on with that narrative and that thesis of ours, even well into 2024. We're in April now, right? This is we're doing this recording on Saturday, April 4th, 13th, sorry, and still no rate cuts. We've had a couple of Fed meetings. They haven't raised or cut rates. We've had Jerome Powell and other Fed members talk about, what they're thinking, what the data is saying, and how they're interpreting it. And all of it points to no rate cuts, maybe even not till September. So the market, specifically the futures interest rate futures market. Yeah, there's like, dot plot is what we call it, where there's quite a bit of speculation and assumption on where uh interest rates will be in the forward months. And that is telling us that we may not see a rate cut till September. So you notice how that works. For those of you that have been following along, the first narrative was of the market and maybe even all the people on talking heads on TV and social media, like, yeah, March, March we could expect 2024 first cut. Well, I hate to break it to everyone, March is come and gone, and we're still at sub 5% benchmark interest rates with no cut. We haven't seen a rate cut. At all. We've seen you know, rates being held for what I think a few months, I think 4 6 months, I think, Chris, already. Maybe even a
Oh
little bit
yeah.
longer. Rates have been on hold. So as I've been saying, same as Chris, we are in a higher than normal rate environment. We are in a higher for longer rate environment. We can expect one or two cuts this year, unless, of course, something changes. But I still believe we can see one or two, but not the four that the
Hmm.
market, and everyone else was anticipating. Oh yeah, guys, the market's, interest rates are coming down. Get ready, guys. That's changing, and that's one of the things that's kind of led into this sort of curling over in the S&P 500. Okay, so there's obviously that relevance there. As far as bond yields, it's also kind of interesting to see bond yields continue to move up. Why? Because that's telling you the bond market is also now thinking, oh, okay, rates are going to stay a little bit higher, so they've kind of started curling up again, started trending up. It's a little bit of a trend line upwards from the start of 2024. Uh, and another key tidbit here is that this is the largest, I would say, sorry, the longest yield curve inversion in history. So I'm not going to break down the specifics, but usually when you have inverted yield curves, meaning the shorter term uh, bond yields are less, or sorry, are higher than the longer term ones. That's an inverted curve, right? Usually when you have longer term bond yields, they're usually higher, and then the shorter term ones are lower, but the yield curve has been inverted for, I would say, probably, I think, a year and a half now. Usually it's never ever stays inverted for this long. Why? Because by now we're usually in a recession. So for now, in this market, in this economy, in this world, in this timeline that we live in, we are not in a recession, and we haven't. been in one. So it's kind of like this scenario where like what yields are inverted. They have been for a year and a half, maybe even longer. We have a higher than normal rate environment. We have the economy continuing to boom. We have gold continuing to moon. We have uh, you know, things like stocks, risk assets continue to hold relatively well. Even with this curl over in the market in the S&P 500 the last week or so, the index is still up about 8% year to date, right? So it's quite significant where markets are continuing to do well, job market's good, inflation has come down, but still around that 3% area, obviously a little bit higher than the Fed wants it to be, but still not the 8 or 9% from 2 years ago,
Mhm.
right? We also see the US dollar. Look at the US dollar take up as well, right? Look like it's kind of crazy, guys. Like I don't know if I can wave this red flag from my roof or something. Maybe you guys could see it from here. But I don't know, like something's going on and it's not very confidence inspiring.
Yeah, and this I find most interesting with the dollar, gaining strength here while gold goes absolutely nuts because you would kind of think there would be somewhat of a bit of an inverse relationship in that, right? Because obviously we're measuring gold at this point in US dollars per ounce. You would think
Absolutely.
as the dollar
You're right.
goes up, gets more strength, you can
Absolutely.
hypothetically buy more gold with it. So you would expect the price to go down, but we're not seeing that at all.
Yeah, you nailed that. That's another good point. Gold and US dollar usually also work a little bit of inverse. So think about that. We've got gold going up like crazy, obviously,
Mhm.
but you still got the US dollar also moving up. Again, this US dollar for the US dollar index is compared not to one single currency, but lot of the larger global currencies, right? So compared to those, it's moving up significantly. These are large moves, guys. Like, these are large moves. These are not something that, you can compare to like how a stock moves, like Tesla moves or like AMD or Nvidia. These are different asset classes, and just by the looks of it, I can tell you these are larger moves. Obviously, in gold, it's quite apparent, but even in US dollar index, for it to go to 104 to 106 in just the past week, that that's telling you something, right? So I don't want to cause a panic or a stir, but right now, when you see things like this happen, from my experience, from my 17 years of experience, when you see like think of it like gravity invert, that's kind of what's happening, where time, space, nothing really seems to gel, nothing seems to make sense, or they're all moving, I would say, opposite to each other. Something's got to give. This is a signal that, look, something might, you know, give, something might kind of snap. And I don't want to say like, okay, we're gonna hit an imminent recession. Oh, we're gonna see a market crash. No, that's not what I'm saying. I'm saying now is the time to hold your cards close to your chest. As allocators of capital, think of yourself as someone who has a certain amount of chips in front of you, and it's your job to allocate that on the board. Right now, is what I'm saying is you don't have to take everything off the board. But ideally, if you can be strategic and take some chips off the board, have them close to your chest, have them close to you, and keep them in reserve, I think that's the way to go now more than any time before this year.
Yeah, we're definitely entering into a point of, more volatility and insecurity, I would say, especially on the global stage. There's a lot going on. And with the US dollar being the reserve currency, it makes, some sense that when you enter times of instability, people will flock to the world reserve currency. And I think that's to an extent, we're kind of starting to see that here. I'm not going to get into everything that's happening in the world right now. We could dedicate an entire webinar to that, and it would still not come so close to scratching the surface. But there's a lot going on, and we're definitely seeing a lot of things happening here. Like Riz said, there's some stuff happening, and we're not gonna say that we know everything that's going to happen, but and there are definitely some red flags that are coming up here that you need to be aware of. But let's take a look here at the important dates in the market this week, and compared to last week with the inflation print, this is going to be a rather tame week here. We got retail sales month on month. They are expecting, it looks like, a little bit of an increase on that, which would be good. Building permits, that should be interesting given the fact that we have so much lack of occupancy in office buildings right now. But of course, that's not just office permits, if I'm not mistaken. But yeah, really not any huge market dates that we need to be really worried about this week that I'm seeing, Riz.
Yeah, you're right. You know, not too much. A little bit of a lull of a week from.
Well, after
Uh,
last week, I think we could use a week off, don't you?
yeah. I agree. I agree. It's been a packed week last week from economic events and whatnot. So this week a little bit of a snoozer, which is completely fine.
Absolutely. I think everybody in the market could use a break. But yeah, three hot inflation prints in a row. Definitely weighing on the market here. I want to give a chance to all of our elite members who are here live on the webinar to go ahead and start posting their questions. But I really just want to kind of comment, Riz, on your concept here of really kind of holding your cards close to your chest, which is obviously our capital right now. It's not the time, to go out and short everything, but it's also not the time to go out and buy everything either. I think, a measured response right now is really what is most important to, preserving your capital.
Yeah, sorry, repeat that for me.
I was saying, a more conservative approach right now, just being, more reserved with, deploying your capital. It's not time to go out and short everything. It's not time to go long everything. We kind of need to wait this out a little bit and see what's going to happen, over the
Yeah,
next couple of weeks.
absolutely, you're right. You know, we in Elite, we've taken that kind of stance for the past few months as well. Of
Mhm.
course, we're trading opportunities that see them. For me, it's been a good year. Still continuing so far. Knock on wood. Still outperforming the market by double, while taking very little risk. But for those of us in Elite, yes, absolutely, I caution to take some profits off the table if you got some positions. Be extremely cautious with going long on things. And of course, that does not automatically mean that you should be shorting things, right? By default, anytime you're not looking to buy or anything, default to be cash. Doesn't default is not short or bet against, right? Default is cash. You only short when you see specific opportunities, or if you want to hedge, or if you feel like, all right, you're ready to take on that added risk because maybe the technicals are pointing lower, maybe the fundamentals economic data is pointing lower. We also have earnings season starting up this coming week slowly, so that will be interesting too as well. Of course, with all the geopolitical stuff happening just today, I can say this earlier today. We've had news of Iran sending some drones, like literally kamikaze drones to Israeli airspace, which have been shot down. I don't know how many have reached, or how many have been uh, destroyed. We just know that they sent some, and you know, uh, few were destroyed. I don't know if there's any damage or any casualties, or if any got through the Iron Dome. But ultimately, we know that's happening. Tomorrow will be interesting once the futures market opens for oil and for the S&P 500. So we'll see that at 6 p.m. Eastern as the market opens.
Definitely, yeah, that was one of the more prescient issues going on, of course, with Israel, striking that the embassy in Syria, if I'm not mistaken, taking out a couple generals. Everybody's
Yeah.
been waiting. Everybody's been waiting for the response, and it seems like now
Yes.
it's finally here.
And the responses like have been like preempted. Like we've seen those breaking news alerts go off on our phone and whatnot. Like,
Oh
uh
yeah.
uh Israel and United States expects an attack from Iran. Like it's been happening for a couple of days. It's kind of weighed on the market, but not really. Ultimately we were talking about this in Elite earlier. Um, and ultimately war is I know it's from a human concern standpoint obviously horrible, and I am completely agreement with that, but from a market standpoint, from an economic standpoint, usually war is considered to be quote unquote positive for the United States, that is, right? Because usually the wars are far removed on the other side of the
Hmm.
ocean. and increases our defense budget, it increases and props up some of the defense industry. And the defense industry is a very large industry, especially for the United States, with hundreds of billions going towards it every year, and
Oh
they
yeah.
employ a lot of people all across the United States. So it's definitely um, an important industry, and war, generally speaking, kind of shifts the narrative around how U.S. citizens feel, because their focus kind of goes from, oh, our gas prices are so high, to maybe, oh, I wonder what's happening in the Middle East. You know what I'm
Yeah.
saying, from a narrative standpoint. So, when you really kind of unplug from what's going on in front of us and kind of take a look at it from a bird's eye view, you kind of see like how these things move and how things happen. And it's quite interesting. It's very interesting. Of course, we will kind of see and adapt and adjust as this whole Iran um Israel situation progresses. I feel like we've all kind of expected it, as you said, with in retaliation from what Israel did
Yep.
in that targeted strike in Syria. But yeah, I mean, all of this stuff, I would say, is kind of moving in inverse correlation to one another. And it's kind of like this jigsaw puzzle that just all the pieces are from all different kinds of puzzles. So,
Definitely. All right. I had a couple questions sent to me here. So, from one of our members, I said on managed healthcare like UNH and Humana, which would be United Healthcare, if I'm not mistaken. He's asking, is this an overreaction, and when would your opinion be to enter this one long? We'll take a look at the other one. Humana was the one that he quoted. Let me dig back here a little bit. So yeah, we're looking at technicals that are back in 21. Those are kind of old, maybe not super relevant, but we do seem to be kind of sitting here on would appear to be like a support zone here. A lot of indecision in this candle here. Not sure if I'm going to go jump in long on this when the market opens on Monday. But as far as healthcare is concerned, like United Healthcare, let's take a look at Humana real quick. What are your thoughts, Riz, on long plays on these?
yeah, so interesting that someone asked this. Currently, we have positions open. Right, Humana, we took a position, we closed for profit.
Mhm.
UNH, we have a position as a week and a half ago. It's definitely a great entry point. It's oversold. Earnings are coming. Keep that in mind. So it's definitely a good entry point in my opinion. We've seen like you said, mentioned, we've seen quite a few healthcare stocks drop, especially with some of the changes. And I think it was like something to do with the U.S. Medicare changes or something like that that kind of had an impact on them.
Yep.
But I feel like it's an overreaction, absolutely. But yeah, I think it's a good entry point for those that are not in, uh, from a fundamentals and a technical standpoint.
Yeah, definitely a bit of an overreaction there. And, not a bad dividend if you want to hold this one long. I mean, that's not insignificant. $1.88 a share. Of course, we are talking about a $400 stock there. Another question here sent to me wants to talk about Nike. Let's get some swooshes in the chat. On the shoe business, like Nike, excuse me, talking is hard. Any more correction in the offering? So I'm guessing we had an offering here for Nike. Thoughts on Nike shoes or sports apparel industry? So, me personally, this is just my personal opinion. I'm not a big Nike fan personally, but I know that a lot of people are. Obviously, it is a pretty big company. It's got some pretty big stars on their roster, so to speak. Definitely looks like we're bouncing off some support here right around 89. But definitely a lot of indecision on Friday. That is about as beautiful a doji candle as I have ever seen. Riz, what are your thoughts on Nike here?
Yeah, I think it's definitely from a technical standpoint looking good. I've been watching this as well. I didn't want to get in after, that red candle on what is it, Tuesday? Sorry, Wednesday, and I was like, okay, I'm gonna hold off, and then we obviously got a little bit of a gap up there. So not a bad entry point at all. It's a good looks pretty good. Just the fact that 89 level held. Again, Friday is kind of a mixed bag, right? With that doji indecision. So I feel like if someone wants to take that kind of technical trade, yes, from a fundamental standpoint, obviously it's a good company, shoes, a giant in the apparel market. Now, from the entire retail uh, clothing industry standpoint, that I feel like anything goes. We know that if the market, I would say, sorry, the economy does start slowing down, if we see retail spending go down, it wouldn't be a shocker to see Nike change their guidance, for earnings. It wouldn't be a shocker. Maybe they have some close calls when it comes to earnings results, right? Maybe they get revised lower. Maybe they just barely have a earnings beat. Maybe they have a flat earnings, from a projection standpoint. Maybe they miss because of lower consumer demand, lower consumer spending. Because we know shoes, you can buy shoes from anywhere from $20 to a few hundred, maybe thousands, right? So, the first thing people pull back on is discretionary spending, and Nike and other apparel brands are discretionary. So if they need to buy shoes, they'll buy something, but they might just buy something a lot cheaper than what you might get for, like, Air Force Ones or Jordans. So that's something to keep an eye on. All right. But if the economy
Skechers.
continues, yeah, there's Skechers as well. So if you have the economy continue to chug along, yeah, I mean, then you have a perfect an entry point where the technicals line up along with the fundamentals.
For sure. This is not financial advice. This is my personal brand preference. Under Armour all the way. You can put Nike in the trash can. But that's again not financial advice there. That's just my personal preference. All right. I got a question from Chirag. Hey, can we take a look at PANW from a technical standpoint? Absolutely. Let's take a look at Palo Alto Network. So obviously a bit of a dip here below the 200 simple moving average, but a very nice bullish move back over it within just a couple of days. So definitely, here post earnings, they got really punished on earnings. Holy cow. Must have been guidance because, man, revenue and EPS looked in line. So, yeah, guidance must have not been too hot. Really nice bounce here off the 50. So we hit the 200, we bounced up there, we hit the 50, we pushed right back down. Just a tiny little dip below the 200 and pushed right back up above it. Not a big surprise given the way the market behaved on Friday that we're seeing a bit of a red candle there on Friday as well. From my angle, this is looking pretty decent as long as we can hold over the 200. But Riz, what are you seeing?
Yeah, you're right. I agree. The fact that it's holding that 200 area, we've got earnings already done. Like you said, it did beat, but it was probably guidance that lowered, eventually rocketed back up again a few days later, only to give all the gains back pretty much. So the fact that it's consolidated and moved above the 200-day moving average looks good. Keep in mind though, because obviously this is tech. Obviously, this is a growth stock. Obviously, this is a large mover. If we see a continued pullback in the market, this too will go lower. And I wouldn't be surprised if it breaks below the 200-day moving average, because at that point, the 200-day moving average will go out the window when everything is selling off, right? So if that's the case. So this is what I mean by these kinds of scenarios where, do you want to even take a long, even though the technicals look similar, like decent? Do you want to go and have exposure and have risk when the current geopolitical market backdrop indicators of whether it's like other financial instruments, all that's going on that I've explained in the rest of the webinar, it's kind of a toss up, right? One thing you can do if you do feel like you want to take this long, you'd like to set up, you want to put on some risk, absolutely take a long, but then make sure you have maybe a mental stop. Maybe if you want to use a hard stop, I don't use hard stops, but if you want to use mental stop, maybe around that 200-day moving average could be something to consider as a stop. That way, if the does market does pull back, you're not there ending up bag holding this.
While Riz was talking, I went ahead and looked at the transcript from the earnings call, and obviously the problem was they only mentioned AI 10 times. You're supposed to do it at a minimum of 17. That's why it dropped so much. I am, of course, joking. That's not actually what it was, but yeah, definitely punished hard here on earnings. But yeah, if the market keeps going, yeah, that definitely spells problems. So, all right, we got one more here from Ravi. It says, wants us to take, what do we think about TSM? Now, if I'm not mistaken, Taiwan had a little bit of an earthquake here a couple days or about a week ago, if I'm not mistaken. But they obviously have earnings coming up. This must be incorrect here. Yeah. because that the date is 3 days ago, so that can't be right. But yeah, he says expected to release earnings on the 18th. Okay. So yeah, obviously TSM here again, tech stock. We talked about that. They do pay a decent sized dividend, so can't complain about that. Definitely, we hit the AI hype here, getting up to about 158. Have pulled back a bit on that, especially ex dividend. But yeah, holding up pretty solid here. Riz, obviously, there's a lot of stuff going on in the South China Sea right now. Is this one that you're going to want to speculate on, or what are your thoughts here?
Yeah, it's a great company, obviously a big player in semiconductors and obviously as proxy for AI. But I feel like it's been overdone. I'm not a buyer personally at these levels. I feel like, if someone could have gotten the meat of the move or maybe they bought in, a couple months ago and they got this move here, great, awesome. I would not be personally continuing to hold it if the trade is in profit, and as a result, I also would not be considering to get in just yet. Maybe if the market environment, geopolitical environment kind of stabilizes, and then I see that this thing is around 135 at that 50-day moving average alongside that multiple support zone, I would then consider it maybe with like a very mechanical trade with the mental stop. Uh, and a potential target. But right now, not very confident inspiring for a long.
Yeah, for sure. So I'm not seeing any other questions from our members here in Elite. Riz, what are your closing thoughts here? What is, kind of your outlook for this week, and what should we be keeping an eye on?
Yeah, I feel like look, we've got earnings coming up, earnings season starting, so that'll be interesting. Obviously, the next 2, 3 weeks are going to be a doozy with a lot of the big ones releasing, not this coming week, but the week after. And then alongside that, we're going to see how things go when it comes to the geopolitical environment. Of course, we've got a lot of the commodities up, even the US dollar. We've got quite a bit of a shift in narrative around rate cuts, being pushed back and potentially from March. They went from March, the assumption went from March to June to now September. So who knows, right? It's like I kept saying to you guys that it's a moving goalpost, it's a moving target. Don't just assume because one financial media outlet or some person on CNBC said, we're expecting rate cuts in March. Don't just take that as gospel, uh, right? Because the more you look at these financial media companies, these talking heads, you realize that they're actually not as well versed or even right as you might assume, right? Just because someone gives them a mic doesn't mean they are automatically someone that should be listened to or even paid attention to.
Great wisdom, definitely something to keep an eye on and be aware of. So, of course, thank you for all of our members who are here on the call live. It is great to have all of you here. For all of you watching on YouTube, on your way out the door, do me a favor, hit that like and subscribe button, and we'll see you in the market on Monday.